Starbucks is a real compounder. It's a company that's been able to grow its profits and its free cash flow consistently year after year after year, making many of the early Starbucks investors very rich in the process. But if we zoom in to the past 5 years, the chart says a completely different story. While the S&P 500 has around doubled over this time, Starbucks stock has gone nowhere, absolutely nowhere. And in a way, the story of Starbucks is very similar to that of other American legendary companies like Boeing and Nike. These companies all have extremely rich histories. They're all long-term compounders, but they've kind of lost their way in the past few years. It's no secret that Starbucks is kind of struggling right now. They're on the struggle bus, really. In September, they fired their CEO that had been in tenure for 2 to 3 years and replaced it with Brian Niccol here in the middle, who jumped ship from Chipotle to Starbucks. So, what's going on at Starbucks and what lies ahead for the company? If you clicked on this video because you're wondering if Starbucks is a good long-term investment, well, my friend, you're on the right channel. In my view, the best way to invest is quite simple. It's not easy, but it is simple. It's finding the best businesses in the world and just not overpaying for them. And this strategy is really good because it gives investors like you and me an edge in this very complicated game. Because most professional money managers, the people with the most funds at their disposal in the world, they're playing a very different game. They're playing a game of short-term results. They have to perform over this quarter, over this year. Otherwise, they start losing their clients and they get fired and replaced by another money manager. And another benefit of this strategy is that it's quite passive and stress-free. If you're a long-term investor, what preoccupies you the most is the business's fundamentals. And these fundamentals, they don't change from one day to the next. As long as the fundamentals go in the right direction and they don't deteriorate, then you can just be happy by owning the stock. And this is good because you can go out and enjoy your life and enjoy the things that you like to do. You don't have to be trading every month, every week. You also avoid taxes and fees, and that's really important for your overall compounding over the long term. So as long-term investors, what we need to figure out is whether the problems that Starbucks is currently going through, are they permanent or are they temporary? In other words, are they cyclical? Is it something that Starbucks management can fix, or is it a symptom of declining fundamentals? If we look over here, we can see that the dividend yield is pretty decent. It's more than double what the S&P can give you. And this free cash flow multiple here of 38, what that tells me is that the expectations for this company are still pretty high. So clearly investors and the market are still expecting Starbucks to turn the situation around. These expectations are what's baked in today's price of $101 per share. Because this here, that's not the multiple of a struggling company. This is the multiple of a high quality company that's still a compounder and that will grow its free cash flow in stepwise fashion over the next so many years. But if we look at the quality rating, my research seems to suggest that the company's quality is declining. Actually, Starbucks received a rating downgrade in the past few days. And remember, the company's quality is just based on 3 factors: the moat, the profitability, and the safety. So let's dive right into the subject, starting with what problem Starbucks is currently facing right now. My apologies for the camera quality. I know it was a bit blurry at the start of the video, but hopefully that should be fixed now moving forward. Right, so Starbucks's most important metric is same-store sales. Basically, this is just looking at the company-wide sales minus any new store that were opened in the past year. In 2024, global comparable store sales declined by 2%. And they give some more detail, which is nice. So this decline of 2% in same-store sales includes a 4% decline in comparable transactions and 2% increase in average ticket price. If you just look at the amount of transactions, of how many people are coming to Starbucks and buying things, that was down 4%. The reason why same-store sales are only down 2% is because Starbucks was able to pump up the prices. What's frightening about this metric is that the worst part of the decline came in the fourth quarter. So it's not like it was a 2% decline for the whole year. Actually, same-store sales probably went up for the first quarter, But by the fourth quarter, global comparable store sales were down 7%, driven by 8% decline in transactions and 2% increase in average ticket price. So really, the amount of people shopping at Starbucks is going down fast. The question that most investors and management are asking themselves is, why are less people showing up at Starbucks? The first reason is these long queues. Apparently, if you place an order with Starbucks, whether that be in person or online via their app, it now takes upwards of 10 minutes sometimes to get your coffee in the morning if it's rush hour. Obviously, this is super inconvenient, especially if it's in the morning right before work. And so, as we'll see later, this is one of the first things that the new CEO is trying to address. Now, the second thing, and probably the most important thing, is the price of Starbucks coffee. All the items on this menu were taken from a city in the US, which is not New York City, so keep that in mind. But what we can see is that the average price for a black coffee is almost $5. For a latte, it's almost $6. Remember that Starbucks also charges extra for any cream that you might want to add, or any type of vegetable milk if you have almond milk or oat milk with your coffee. So these prices can easily climb up and reach $7, $8, $9 for a single cup of coffee. So knowing these two things, that Starbucks' line are getting pretty insane and so are the prices, if you're a customer who just wants the quick morning coffee, a hit of caffeine to be able to work in the morning, well, all of a sudden, Starbucks' competitors that are lower priced seem a lot more attractive. Starbucks has been at war with lower priced brands like McCafe, Tim Hortons in Canada, or Dunkin' Donuts. And while these brands don't seem as appealing as Starbucks, which has built an image of premium coffee for a very long time, well, if you're a customer who just wants a shot of caffeine in the morning to be able to be awake at work, these will do just fine. And of course, for the hipsters out there, those of you that like nice things, who like to sit down in a coffee shop to read or to speak with friends, well, there's always the independents. Most of the time, their coffee is premium. Their prices are probably similar to what Starbucks has to offer, and the setting is just overall nicer. But that's only in the US. Another super important market for Starbucks is China. About a decade ago, Howard Schultz, who's the founder of Starbucks, made the decision to go heavily into this market and put lots of investment. He really thought that China was going to be Starbucks' growth avenue of the future. And for a long time, this worked. Starbucks was one of the only very successful Western companies to make it in China, like Nike, Apple, and then Starbucks. The thing is, though, Starbucks is now getting its butt kicked in China by some local competitors. They're offering lower prices, a similar experience, they're the local champion, and yeah, Starbucks is losing market share in China. So we can see here that the revenues for 2024 were pretty much flat compared to last year. Yes, Starbucks opened up a lot of new stores, but the sales per store declined, which leads to a roughly flat revenue. What's interesting to note is that this is the lowest growth that Starbucks has seen since 2009, if you discount the 2020 year of COVID, of course. We can see that the gross margin and the operating margins are staying roughly consistent, so is the cash margin. On one hand, this is good. It means that Starbucks is keeping its pricing power intact. They're not choosing to compete with lower competitors like McCafe and Tim Hortons by lowering prices on their own menu. So I do like that. On the other hand, we talked about great companies earlier. Well, great companies are able to raise margins over time. And clearly, this is not happening with Starbucks. Companies, they always have a set amount of fixed costs, which are costs that they have to pay no matter what every single year. Now, what you want is that as a company grows its revenues, the fixed costs stay the same. And so more of this incremental revenue ends up going to the free cash flow. Now, here we get to the part that I don't really like about Starbucks. If we look at the free cash flow, and remember, this is the amount of cash that the company is actually bringing in every year. The figures you see in these charts might differ a little bit from what you might see on other platforms. And this is because my calculation of free cash flow deducts share-based compensation. Because if you look at a company's financials, usually they account share-based compensation into free cash flow. This is the cash that they're getting from issuing more shares and diluting shareholders. and I don't want to count that in their free cash flow. And clearly, Starbucks hasn't really grown its free cash flow in almost 10 years. And it's not like this free cash flow is staying constant because Starbucks is investing a lot in capital expenditures. Because yes, these are going up, but not all that much. Even the operating cash flow is pretty stagnant. Now we move on to the return metrics of ROIC and ROCE. If you have a high ROIC and a high ROCE, that's the hallmark of a high quality company. And clearly, Starbucks is still really good at bringing in cash profitably. But once again, I might be nitpicking here, but what I notice is that the ROIC of 2024 is the lowest that it's been in a very long time. The company's return on invested capital was lower in 2020. Of course, that was the COVID year. It was lower in 2013 as well. That's when Starbucks took a massive hit, one-time liability, and the free cash flow was negative, which is why the ROIC is very low. And 2009, of course, was the great financial crisis. Another thing that makes me uneasy is all of this debt. It's not really going down. Funny thing is, Starbucks was actually paying down debt when interest rates were low, and then now it's taking on debt when interest rates are higher. This debt that you see here on this chart does not take into account all of the operating leases. So actually, Starbucks' financial obligations are quite a bit more than this. But despite that mountain of debt that I just showed you, these metrics, which measure how easily Starbucks is able to pay down its debt or its interest payments, are still pretty good. So it's not like Starbucks is about to go bankrupt. If we look at the dividend, yep, it's going up over time. And actually, Starbucks just announced a 10% increase a few weeks ago. But once again, this dividend is growing much faster than the free cash flow. Actually, the dividend is growing and free cash flow is going down. And all I want to say here is watch out. If the dividend starts to become routinely higher than the free cash flow, then Starbucks will have to cut this dividend. And to finish off this portion on the financials, I want to look at the free cash flow multiple history. Today, Starbucks' multiple is at a 32, which is higher than when the company was still a high growth business in the year of 2015, 16, and 17. So following a disastrous year in 2024 at Starbucks, one CEO gets sacked and the other one replaces him. That's Mr. Brian Niccol. And Mr. Brian Niccol here, he's loved by Wall Street. Wall Street just loves this guy. But they love him for a good reason. This guy has a really good track record. He first started at Taco Bell and he turned that company around from a dying restaurant with very low sales to a very fast growing, appealing brand for people to go eat Mexican food. And then his big breakthrough came at Chipotle. So Chipotle was always a fast growing, up and coming restaurant brand. And then in 2015, they ran into some food issues, food hygiene to be more specific. There was an E. coli outbreak, and that sent the stock down for 2 to 3 years to lows in 2018. And Mr. Brian Niccol joined Chipotle as the CEO in 2018, and his returns were spectacular. Not only did he turn the company around and start growing sales again, but he turned Chipotle into one of the fastest growing companies in the S&P 500. So if anyone's going to be able to fix Starbucks, it's Brian Niccol. He's only been at Starbucks for 2 to 3 months now, but he's already had time to do some rounds and speak to people, and he identified 4 key areas of focus that he wants to work on in order to turn around Starbucks. The first is empowering our baristas to take care of our customers. And basically what he's saying here is that he wants to make employees more happy so that the culture at Starbucks improves, which should reflect back on the customers. But to be honest, Starbucks has always been an example in the quick service restaurant industry. They've always had the best employee benefits, the best employee wages. So I don't really see how much more room for growth there is there. Okay, the next area of focus is get the morning right every morning. And basically, this is just a catchy phrase to say that the morning at Starbucks needs to be more efficient. They need to get rid of the queues and make customers get their drinks faster. And he's already thinking of implementing a few changes for 2025. For example, there will be now a condiment bar. So after you pick up your drink at Starbucks, you go to the condiment bar and you can add your own milk and sugar and all that by yourself. So that'll save some time. He also wants to add some machinery to, help the employees be quicker in preparing the coffee. And finally, he wants to reduce the menu options, so make your drinks less customizable, because that'll also improve efficiency and help workers be quicker. So everything here is about increasing the throughput and decreasing the queues that we were speaking of at the start of the video. The third focused area is reestablishing Starbucks as the community coffee house. We're committed to elevating the in-store experience, ensuring our spaces reflect the sights, smells, and sounds that define Starbucks. Our stores will be inviting places to linger, with comfortable seating, thoughtful design, and a clear distinction between to-go and for-here service. In essence, he's saying that at every store, getting your coffee has become too transactional, and he wants to go back to the old atmosphere, which was more laid back and where people used to just come and spend the day at Starbucks. And finally, the fourth point is telling our story. And here, what he's saying is that Starbucks wants to have more control of the narrative. They want to have more control of their brand. So how are they going to control their image more? Well, they're going to start advertising on classical channels like linear TV instead of just the rewards app. And they're also going to stop diluting the brand by giving too many promotions in the rewards app. So, what's the take on Starbucks? In my opinion, Starbucks is in a bit of a conundrum or a bit of an identity crisis right now. Let's rewind a bit. What makes Starbucks Starbucks? What makes Starbucks such a great company? This was a company that pretty much revolutionized the coffee culture and coffee industry in North America. When it comes to coffee in North America, there was a before Starbucks and an after Starbucks. Americans used to enjoy their coffee as instant, almost as fuel to give them more energy for work and other things. But Howard Schultz, he went on a trip to Milan, to Italy. He experienced the espresso bars. That really left a mark on him, and he tried to reenact that experience with Starbucks in Seattle. And so the coffee beans were of very high quality. People came to enjoy their coffee and they would stay in the establishment and have a chat with their friends and leave. And this was really cool and unique for the time. A lot of Americans really identified with this and they loved the new coffee. And they wanted to identify, their identity was with the Starbucks brand. And based on this culture and this experience, Starbucks was able to build a brand that had pricing power. And so, in a way, it didn't really matter when the likes of McDonald's and Tim Hortons all came into the mix and started selling coffee and imitating Starbucks. Because Starbucks was always seen as higher quality, as premium. And the people that went to Starbucks thought that of themselves as well. But at some point, Starbucks had to reinvent itself around the time of the great financial crisis. Howard Schultz came back to the company and he started opening a lot more stores, increasing the throughput so that more people would come and get coffee, and really jacking up the prices and flexing that pricing power. And so today we're at a point where every city has multiple Starbucks. There's a Starbucks at every street corner, and the prices on the items sold at Starbucks are really high compared to competitors. There's a really funny quote I find, and it's someone who says, 30 years ago, going into a Starbucks was like walking into someone's living room. Books were on the wall, plush chairs and couches, nice lighting and carpet. Now it's a Burger King. And it makes sense from a profit generation perspective that an establishment makes more money when there's more customers coming in, it's more in and out, come and go, and less of a third space to just hang around in. But now management thinks that that's what Starbucks needs to go back to. The problem that I see personally is that in 30 years, the coffee culture and the landscape has changed dramatically. North Americans are much more used to having coffee in independent shops that have popped up a bit everywhere. I'm sure that in every city, there are as much independent coffee shops as Starbucks is. And so the early Starbucks customers that identified with the brand and came to Starbucks for the experience, well, now they're customers of these independent coffee shops. So I really can't see how Starbucks can keep competing with discount coffee makers like McDonald's on the low end and then independent coffee shops on the higher end. It's almost like the company's being stretched so much. How do you maintain brand image in all of that? And if you can't maintain the brand image, then how do you maintain pricing power? At the end of the day, people know that they're coming to Starbucks to have coffee, and coffee is a commodity. Coffee is something you can make at home. It's something you can get from McDonald's or Tim Hortons or Dunkin' Donuts. Starbucks has been really good at innovating in the past. They've created some super iconic flavors. Everybody's heard of the pumpkin spice latte. They invented the frappuccino, the nitro cold brew, all these techniques to make the coffee different to attract customers to their stores. In the past 5 years, it almost seems like people go to Starbucks now to get some sugary desserts. It doesn't even feel like coffee anymore. So from everything I'm saying right now, you probably think that I'm negative on Starbucks and that the stock price cannot go higher from here. That's not what I'm saying. What I am trying to convey though through this video is that the turnaround is still quite risky and it's probably going to take longer than you or I expect. Before the new CEO came in, Starbucks was trading for $75 per share. As soon as the CEO was announced, before he even started working for the company, the stock was up 30%. So clearly today the expectations are that Starbucks will be able to turn itself around and be profitable way into the future. Personally, I want to see improvements in the business fundamentals before this quality rating can start trending upwards again. If you want more information on Starbucks or if you want access to analysis of other companies, all of it is on Rated A. There's zero risk to sign up. It's free for the first 7 days and you can cancel anytime. You can filter companies by quality rating. You can filter companies by value rating and income rating for those of you that are more interested in value or dividends. One thing I can say is that according to Rated A methodology, there are much better stocks to buy right now than Starbucks. And if you want to know how I'm investing the company's money, you can get access to the full portfolio in the holdings tab. All right, thanks for watching and I'll see you in the next one.